In this wonderful class, we are going to begin with concept number 10. Now, fundamentally, what do we mean by options valuation? There is a price that you pay to buy an option, correct? Don't get confused with exercise price or strike price. Strike price and exercise price is not the price at which you buy an option, correct? That is the contract price through which you can buy or sell the underlying. Options being a derivative instrument, a derivative contract, there has to be something which could be underlying. That underlying component could be a share, could be an index, could be a currency, could be a commodity, could be interest rates, it could be anything. So currently we are talking about options where the underlying would be an equity share. So what happens? Suppose there is a call option. I have explained you what are call and put options. So if there is a call option, it gives the holder the right to buy. So suppose I go to derivative market and I want to buy a call option which has exercise price of 400 and the underlying is the equity share of X Limited. So what happens if I hold that option? I will have right to purchase equity shares in X Limited at a price of rupees 400 per share, irrespective of the prevailing market price. Being a call option, I will be in the money. As a holder, I will be in the money when the market price of the share is greater than the exercise price, correct? Then it makes sense to exercise the call option. If the price is above 400, I mean if the market price of the share is above 400, you are definitely supposed to exercise the call option. So if I am holder, I will definitely exercise that call option, because the price which is prevailing in the market, suppose that is 430, but I have a right to buy at rupees 400. On exercising this option, the differential between 400 and 430 as a surplus will come to my pocket as my gain. Now, all this doesn't include the price of the option. Here what I was telling you was comparison between two prices, one that was strike price or exercise price, which in my example was rupees 400 per share, and the prevailing market price of the share was rupees 430. However, the day I purchase this option, because I am an option holder, I will buy this option from someone. That counterparty will be option seller or option writer. I will be option buyer or option holder. Now what happens? Obviously, to buy this option, I have to pay something. In earlier classes, in the basics of options, we have learned that what I have to pay is basically considered as premium. That premium is the price of the option. I repeat, the premium of the option is the price of the option. That is the price at which you can buy or sell an option in the options market. So if option is an instrument, a marketable instrument, if it is a marketable contract, if I want to buy or if I want to sell, there has to be a price for that, right? And the price for that option is what we refer to as options premium. So what is this option valuation all about? It is basically to identify whether the pricing of the option is appropriate or not. Because if something is available in the market at any price, you will not just go and buy that, right? You will always determine the fair price of that. Let me give you examples. We have seen in Forex chapter, forward exchange contracts, there will be a forward rate quoted by bank, but you always determine a fair forward rate, correct? FFR, fair forward rate, to identify whether the forward rate quoted by bank, is it appropriate or not. You go to derivative markets, future market, there will be a future price quoted for a particular equity share. Maybe we are talking about stock futures and there's a futures price quoted. Immediately what you will do, the quoted futures price, whether it is appropriate or not, you apply the fundamentals of FFP, fair futures price. Then you compare with the actual futures price and you identify whether the futures contract is underpriced or overpriced, correct? Finally, when you land up to the options market Of course, we call this as FNO market, that is futures and options market, but options will be a different segment in this derivative market. So when you are dealing with options in the derivative market, what you need to consider? You need to consider that whatever be the price of option, I am repeating this point, whatever be the price of option quoted in the market, which is basically representing option premium, the price quoted for the option is the option premium. Whether that premium is appropriate or not. So we are trying to calculate kind of fair premium, which will be called as appropriate value of that option, and we will have to follow a procedure for determining the option value, and that procedure, that process of determining option value or the fair value of the option, that process of determining the fair value of the option is referred to as option valuation. Now someone might ask me that, sir, why are we learning option valuation? Obvious point is, if you are finding that a particular option is traded in the market at rupees 38, you find the fair value of that option and you find that the fair value of that option is just rupees 20. That means by using some option valuation model, you found the fair value of the option as just rupees 20. Now it is traded in the market at rupees 38. So only a fool will go and buy that option. I will never buy that option if that is the case. I would rather sell that option, means I'll prefer being option writer for such an option. So what happens, if something is floated in the market at some price, won't you be willing to check whether the price is appropriate or not? You are actually very keen on doing that, very keen. I'll tell you why and how. Suppose you go to a garment store, suppose you want to buy a piece of denim and you observe the quoted price as 3,200. Immediately you will check on all online portals, what is the price quoted over there? What options do you have? You find the same pair of jeans available at just rupees 2,500. So what smart thing you will do, in that garment store you will try the fitting of that jeans upon you, and when you find that you are looking awesome and you find that this is a right fit for you, you decide that you are going to buy, but you will not buy from that store because in that store it is priced at 3,200. You will better book that same product online from some available portals and you will get the delivery at home. On top of that, if the product is not as per your requirement, you have choice to return it back. When so much of facility is available, why won't you choose the rightest course of action? And what you did, you found the fair value of that product. Quoted price was 3,200. You are not willing to buy at 3,200. Why? Because you know the appropriate price is 2,500. But what if there was no such appropriate price available? Then you were blind. Then you had no idea about what would be the right value. In that case, just because you like the product, you will buy it. Correct? So comparison has to be made. If you have comparatives, your decision making go better. If you don't have comparatives, your decision making is just incomplete. Point is, in this case, we are trying to determine the fair value of the option, and through the fair value of the option, we will compare with the actual price for that option, that is the premium quoted in the market, and the option over there could be found as either underpriced or overpriced, sometimes in rare cases even fairly priced. If it is fairly priced, then fine, buying or selling that option we could be little indifferent. But if it is underpriced, anything which is underpriced I will prefer buying, anything which is overpriced I will prefer selling. So under what situation you should become an option holder, under what situation you should become an option writer can be understood very well with the concept of options valuation, and that is what we are going to learn. So I'm sure you people have understood what exactly is the meaning of option valuation, the process of determining the fair value of the option at a given date. Of course, because we are trying to buy and sell that option in today's date, we would want to find the fair value of the option in today's terms, that is the present value of the option. So obviously the option is exercisable at a later date, but we would want to find its fair value in today's terms. That is what we call as options valuation. Now, what we do is we find various models for options valuation, and these various models can be broadly classified into two categories: the traditional model and the modern technique. The traditional models would encompass three different models, that is portfolio replication model, risk neutral model, and binomial model. And an extended version of binomial model could be multi-period binomial model. Whereas the modern techniques, they follow one particular model which is mathematically proven, that is Black and Scholes model, and Black and Scholes model has such a wide acceptance worldwide that every derivative market uses Black and Scholes model for pricing of the option. So that is the beauty of that concept, and when we learn all these option valuation model, you would understand one thing, that all these option valuation models have been designed for determining the value of call options only. None of these models can be applied for determining the value of put option. So as an extension to this whole learning process, we will learn a theory called put call parity theory, and through that theory we will learn how to derive the value of a put option depending upon the value of call option. So what you do is, you have various option valuation models, but all the models are designed for determining the value of call options only. Apply any model, any suitable model, and determine the value of call option. Then apply put call parity theory on that call option value, and through that you derive the value of put option applying that put call parity equation. And that is how, when you want to determine the fair value of a put option, in other words, when you are approaching option valuation with respect to a put option, the process goes little longer. But I can promise you friends that this journey of option valuation is extremely interesting. Some people, what they do is they go completely mechanical with the process of option valuation, step 1, step 2, step 3, and you got the answer. Don't take me wrong, even I am going to do that for you, correct? Because in exams we have to be precise in writing our answers. However, if you just stick to step 1, step 2, step 3, step 4 mechanism, we are not willing to be mechanics, right? We are going to be chartered accountants who are known for their brains, and thinking is required over here. So it is very, very important to understand the fundamental reasons about why we are doing all this calculation, why this process of calculation, what is the core logic behind that calculation. So my objective is not to restrict you with a process of applying some steps and determining the value of option, but why we are doing all this, we need to understand it very well. So let's do one thing friends, let's write some notes over here and then I take you ahead. So at the early part, you just write premium is considered as the value of an option. Option valuation refers to determining the fair amount of premium. That is a question, how much should be the premium? On comparing such fair premium with the actual premium, one can make out whether an option is underpriced, overpriced, or fairly priced. Option is underpriced, you would buy such option. If option is overpriced, you would want to sell such option. Let us move ahead and write further. Value of an option can be determined through portfolio replication model, risk neutral model, binomial model, or even Black and Scholes model, which is basically considered as the modern approach for determining the option value. All the above approaches can be used for determining the value of call options only. For determining the value of put options, number 1, first determine the value of call option for the same exercise price, and then the next step will be use put call parity theory for determining the value of put option through the value of call option. Let us move ahead and now begin with the next concept, that is concept number 11. The first model of option valuation, titled as portfolio replication model. Now before I give you any notes in this regard, I will have to first explain you the whole concept about this portfolio replication model. Beautiful model. The person who developed this definitely would have thought so much, because the moment you learn the conceptual base of portfolio replication model, you would start loving the process of option valuation. I am just always wondering about people who would have thought about these kind of concepts in the origin and they derived the value of these options. So, portfolio replication model. Let's first break down this term, portfolio replication model. So, you have an investment portfolio comprising of various stocks. So, you have a portfolio and you want to create a replica, and you want to create a replica of that portfolio not by buying the shares but by creating a portfolio of options. And you do one thing, you create such a portfolio which can just represent the exact outcome of the stock portfolio. If you are successful in doing so, and if you can prove by end of the period, maybe 3 months, 6 months, whatever be, by end of that defined period, if the value of your stock portfolio is exactly matching with the value of your option portfolio, if the future values are at parity, the present value also must be at parity. Therefore, how much money did you invest in stocks, that is known, and how much money therefore you should invest by investing in options, you can derive out of that. That is the whole fundamental ground behind portfolio replication model. So, let me tell you what I am going to do for you. I am going to first take up an example through which I will explain you how to solve a question on portfolio replication model. So, you might feel like killing me, because I just told you some time back that you should never go mechanical, you should first understand the concept. And I am going to take you to a mechanism of a step-by-step process. But let me do that, because it is sometimes important to understand what we have to do and how we have to do, and then it makes sense to go deeper and understand why we are doing that. So, let us answer that reasoning part at little later stage, and what we do is we first begin with the whole process of calculation and the process of presenting your answer in examination. And of course, we need to write some important notes over here. So, please write under the heading concept number 11, portfolio replication model. This model creates a replica of a stock portfolio through options, and these options necessarily have to be call options. The stock portfolio will contain a single equity share whose option valuation is required. The option portfolio, on the other hand, will contain any number of options to match with the stock portfolio. Through this created match, the value of a call option can be determined. Let us move ahead and let us take up a calculative example given as question number 17. Current market price of the share given as rupees 400. 1 year call option is available at an exercise price of rupees 440. Risk free rate of interest is 10% per annum. The probable market price at end of the year will be, so that is basically your expectation about what would be the market price. So, there could be a lower probable price LPP, that is rupees 360, or there could be a higher probable price that could be 480. Determine the value of call option using portfolio replication model. So, as I told you that we are not going to first go into the logic behind application of this model. Instead, we first understand what we have to do in this model. So, the very first step that you do is you identify what is the spread in the price that you are expecting. Spread means the difference between the lower probable price and higher probable price. That difference you figure out, and what we find over here, 480 is the higher probable price and 360 is the lower probable price. So, gap between these two, that is HPP minus LPP, that will be the spread in the market price of the share or probable price of the share by end of the year, and that we find as 120. That becomes our first step. Second step would be determine the value of option at each of these. So, at lower probable price, what will be the value of option? At higher probable price, what will be the value of the option? So do you know how to determine the value of option at lower and higher probable price? Let me just remind you, when do we exercise a call option? Because don't forget, this whole example is about a call option, right? When do we exercise a call option? When it is in the money. And when is a call option in the money? When the expected market price or the probable price is greater than the strike price or exercise price. In our example, the strike price is 440 and the two expected share price that we are having as probable price by end of the year, one is 360, one is 480. Obviously, if the share price goes to 360 and the option exercise price is 440, we are not going to exercise that call option and the call option will lapse. Its value will become 0. This we have learnt in the basics of options, right? So the value of the call option will become 0. What if the price is the higher probable price and it goes to 480? In that case, the market price will become 480 for the share and the exercise price of that option is just 440. Then you will exercise that option and you get the differential as your gross payoff or the value of the option, and that value of the option will be market price minus exercise price. That will be 480 minus 440. In this example, that would give you 40. So now you got two different values of the option. At the lower probable price, the value of the option will be 0 because the option was not exercised, it got lapsed. At the higher probable price, the value of the option will be rupees 40. So in the second step, when you determine these two option values, also find the spread in the option value. So now you take the difference between 40 and 0. So 40 minus 0, the spread in option value is rupees 40. So in the first two steps, we got two spreads. First one was the spread in the probable price of the share by end of the year, that was 480 minus 360, that was rupees 120. Second step was to arrive at the spread in the option value, that was difference between 40 and 0, that was rupees 40. Spread in share price is 120, spread in option value is just rupees 40. Now you find a ratio by taking the numerator as spread in share price, that was 120, divided by spread in option value, that was 40. 120 divided by 40, that gives you 3. What is this 3? 3 will be the number of call options that you should hold against each share. So if your portfolio consists of 500 shares, correct, your option portfolio should consist of 3 times of 500 shares, that should be 1500, correct. Thereafter, you apply the equation and determine the value of call option. How to apply that equation? Even that equation has a logic, but currently I am not going into that logic. I am just explaining you this process, and let us do one thing. Let us understand how to present the solution over here. In your solution, what you do is, first you write this line, determining the value of call option using portfolio replication model, and you are going to exactly apply the same process as I explained. Step 1, determine the spread between the two probable market prices expected by end of the period. So spread will be higher probable price minus lower probable price. So in our case, the higher probable price was 480 and the lower probable price was 360. So 480 minus 360 will be the spread in the share price, that will be rupees 120. Second will be determine the spread between the two probable option values expected by end of the period, that is on maturity. So spread equals to option value at higher probable price minus option value at lower probable price, that will be 40 minus 0. How we got 40 and 0, I have already explained you, but we need to explain the examiner how we got 40 and 0. For that we have given reference to working note number 1. Don't forget that how we got this 40, we have to explain this calculation of 40 and 0, both the values, through working note number 1. So let us first do that. In the first working note, you mention that option value for a call option when exercised, it is always MP minus EP, that is market price minus exercise price. If higher probable price prevails, that is 480, option value will be 480 minus 440, that equals to 40, because you are exercising the option. If lower probable price prevails, that is rupees 360. So because the condition for exercising the call option is not met, you know what you do is you let the option lapse and the value of the option will be declared as 0. This is how you have to present the working note for finding the value of option at higher probable price and lower probable price. So let us move ahead and write up the next step in the process. Determine the number of call options to be contracted against each equity share. N equals to spread in probable share price divided by spread in probable option value. That was basically 480 minus 360 divided by 40 minus 0, and the answer is 3 call options. You could have directly written as 120 divided by 40, that was all fine. Let us move ahead and write up the fourth and last step. Formulate the equation and determine the present value of call option. So we will write up the equation this way: S0 equals to N into C plus PV of lower probable price or exercise price, whichever is lower. So S0 indicates the spot price. Spot price of the share was 400. N into C, N is basically the number of call options against each share, that was 3, and C is the value of call option. We have mentioned over here that determine the present value of call option, that is C. So C is the present value of that call option. So 3 into C plus PV of, that is present value of lower probable price, that was 360, or the exercise price, whichever is lower between these two, you have to consider that. So it will be obviously PV of 360. So for determining the present value, we will have to refer to the risk-free discounting rate given in the question. So risk-free discounting rate or risk-free interest rate given in the question was 10% per annum. So what we do is 400 equals to 3C plus 360 divided by 1 plus 0.1, basically just to determine the present value of the lower probable price in this case, because between the lower probable price and exercise price, the lower value was 360, that was the lower probable price, and we take the present value of that lower probable price. That present value we add to the 3C, and then aggregate of these two should match with 400, and when you solve this equation, 360 divided by 1 plus 0.1, that is 360 divided by 1.1 would give you 327.27, and then 3C will be 400 minus 327.27, that would be 72.73. So value of C will be 72.73 divided by 3, and what you get is 24.24. Let us move ahead and write up the next heading, that is concept number 12, risk neutral model. Now the moment I even mention that, write the next heading and I take you to the next concept, people would really go mad at me. They would say, sir, are you really joking? You are always saying that try to understand the concept, try to understand the concept. Where is the concept? You are just jumping from one concept to the other concept. Where are concepts? Where did you explain? So I would just ask you to keep patience. Keep a lot of patience. I will discuss with you what I have done. I have planned to take up that portfolio replication model entire explanation in the extended part of 8th lecture titled as lecture 8A. So please don't miss it out. If you are wanting to view that first, I am allowing you. It's your video lectures, right? You can do anything with this. You can stop this lecture right away, go to lecture 8A, watch that, and then come back over here and resume. So I have purposely done that because sometimes many students who are not interested in learning that logic, why should they have the stuck in their flow? So some people will always be upset with no matter what I'll do. But anyway, let us continue with this risk neutral model. So here I'll do one thing. I'll just give you a very important note over here. As per risk neutral model, the risk free rate of interest is a weighted average of rate of returns at higher and lower probable prices, where the weights used represents the probabilities of rise and fall in prices. Let me take you ahead and show you the equation of risk neutral model. So risk free interest rate is basically rate of return at lower probable price into probability of fall in price plus rate of return at higher probable price into probability of rise in price, or the same risk neutral model equation can be written little differently, that is maturity value of RFI. RFI stands for risk free investment, will be equal to lower probable price into probability of fall in price plus higher probable price into probability of rise in price. I want you people to write these equations and then I will explain the entire equation logic by taking an example. Let me explain something over here. So I promise you one thing, the logic of risk neutral model I'll be explaining right away, okay? I'll not postpone that logic. So risk neutral model, it is first of all based on an assumption. In fact, for that reason, portfolio replication model, risk neutral model, binomial model, all these three models in common take some assumptions, and that assumption is by end of the year or by end of the period there will be only two probable prices, a lower probable price and higher probable price. Means it is something which is based on only two outcomes, only two outcomes. For example, if you are tossing a coin, there will be only two possible outcomes, either head or tail. There cannot be a third outcome. However, when we are talking about a share today which is having say market price of rupees 400, its price after 1 year could be any price, right? It could be any price. Here we are going with an assumption that there will be only two possible prices, a lower probable price or a higher probable price, and that is why this is a basic idea about binomial. Binomial means there will be two outcomes. So binomial model is based on the fundamental point of these two outcomes that we are expecting. In reality, the number of outcomes will be too many, and that is where these traditional models lack, and that is where Black and Scholes model, it overtakes all these models, because these models are based on assumptions which are theoretical. In real life this may not stand. Anyway, the core logic of Black and Scholes model also originated from these traditional models only. That is why understanding traditional models is required. So coming to our point of risk neutral model. So if you can recollect the example that you took in question number 17, you just some time back you have solved that question. In fact, I generally even remember the data of that question. As per that question, the current market price S0, correct, the spot price was 400 for the share. If you invest your money in the stock market, 400 of today could either become 360 if the price falls, or it could become 480 if the price rises, correct. So if you are investing rupees 400 today in stock market, there can be two possible outcomes. Either after 1 year the wealth will fall down to 360. So from 400 to 360, it is a decline by rupees 40, means a decline by 10%. Or it can increase from 400 to 480, so increase by 20%. So increase by difference is rupees 80, so increase by 20%. So if you are investing in stock market, you can either earn 20% or you may lose 10%. However, there could be other possibility that if you invest in money market, you are sure to always earn, because money market will give you risk-free investment opportunity. So 400 of today with money market interest rate informed in that example as 10%, 400 of today will become 440. So risk neutral model believes one thing, that there could be two probable prices of the share. There will be a lower probable price, in that example it was 360, there will be a higher probable price 480. Now because I am saying probable prices, means what could be the possibility of rise and fall in the price can be quantified. When a possibility is capable of being quantified, we don't call it a possibility, we rather call it probability, correct? That is what we mean by probability in mathematics, that you can quantify what is the degree of possibility of occurrence, and that is what we call as probability. So when I say lower probable price, that means there has to be a probability of fall in price, there will be a higher probable price, so there will be a probability of rise in price. So you formulate an equation, lower probable price into probability of fall in price plus higher probable price into probability of rise in price. Whatever average value you get over there in the stock market, risk neutral model believes that eventually on a long run in money market also you would earn the same. Now this is again a theoretical assumption, right? You may not earn the same, you may earn differently, but these are the assumptions taken by these models, you can't help it. So when you formulate this equation, you can either use the value or the rate of return. So if you are talking about rate of return in stock market, either you can earn a negative 10% or earn a positive 20%, weighted average of which will be that rate of return which prevails in money market. In that example it was 10%. So all these facts and figures what I am talking about, don't wonder from where I am bringing these figures. I am bringing these figures from the example given in question number 17. So what I do is I take you directly to a question over here. This question will be the next question, that is question number 18, and this question says use the data given in question number 17 and determine the value of call option using risk neutral model. So again basically this question 18 is also pushing you back to question 17. So for your reference I will display question number 17 once again, but question number 17 demanded the calculation by portfolio replication model. So the only change that we now have to apply, this entire data remains same. The change that we have to apply is in place of portfolio replication model that you actually used in question 17, now you use risk neutral model. So how to do this? I have already given you a hint. Let me explain once again over here. Look at the two probable prices, the lower probable price and higher probable price. If you are investing your money in stock market, anything can happen with your money. It can either become 360 after 1 year or it can become 480 after 1 year. However, if you invest in money market is going to give you a risk-free rate of 10%. So if your investment value is 400 today, it will become exactly 440 after 1 year. So one side you invest in money market and you definitely get 440 after 1 year, or you invest in stock market and you either get 360 or 480. Both of these will have their respective probabilities. We don't know that probability yet, but we can determine that probability. So basically 360 is the lower probable price. This will be multiplied to the probability of fall in price, and the higher probable price, that is 480, it will be multiplied to the probability of rise in price. When you find the weighted average of these two, where weights will be the probabilities, that weighted average will match with the maturity value of risk-free investment. So where 400 in the money market would become with 10% interest rate 440 after 1 year. That is the idea behind risk neutral model, and let me show you how to present the solution by applying risk neutral model. So what we do is we first work out the rate of return. So rate of return will be S1 minus S0 divided by S0. You know S0 is the spot price, that is current market price. S1 could be the expected market price after 1 year. If you don't want to write S1 minus S0 divided by S0, if you write P1 minus P0 divided by P0, even that is all fine. So rate of return at higher probable price will be 20% positive. Rate of return at lower probable price will be 10% negative. Let us move ahead, and what we now do is risk-free interest rate equals to rate of return at lower probable price into probability of fall in price plus rate of return at higher probable price into probability of rise in price. Now what we will do, this equation you have learnt already, right? Through this equation we are not going to find the risk-free rate because risk-free interest rate was already given in the question. What instead we can do, the rate of return at lower probable price and rate of return at higher probable price, even that you have already determined, correct? That was the working note earlier you made. So through this equation, what we are going to find out eventually, the probability of fall in price and the probability of rise in price, because there are only two possible outcomes, either the price will fall or the price will rise. These are the two possible outcomes. If the price falls, its probability, and if the price rises, its probability, both taken together will always aggregate to 1. That means probability of rise in price plus probability of fall in price taken together aggregate will be 1. So if I assume that probability of rise in price is considered as x, probability of fall in price will be 1 minus x. When you substitute all the known values and you substitute the probability of rise in price as x, you can definitely write the probability of fall in price as 1 minus x. Then we will get this one equation with one single variable, that is x. You get the value of x, you get the probability of rise in price. So you get the probability of rise in price, you get the probability of fall in price. Then what you do, what we do with this probability, by end of the year, the option value could be either 40 or 0. Now from where did we get this 40 and 0? You just recollect, while solving question number 17, we have figured out that if the market price goes up to 480, option will be exercised, because the strike price or exercise price is 440 and the prevailing market price at that time would be 480. Definitely it's a call option, and call option is always exercisable when the prevailing market price is greater than the strike price. So because market price is greater than the strike price, you will exercise the call option, and the differential value, which will be the value of the option, will be rupees 40. On the contrary, if the price falls to 360, you are not going to exercise the option and its value would become 0. So value of option could be either of these two, either 40 or 0. So when the option value could be either 40 or 0, what is the probability that the option value will be 40? Same probability, that is the probability of rise in price, which you have already found, and the other probability will be the probability of fall in price, that will be multiplied to 0. So probability of rise in price multiplied by the option value at higher probable price plus probability of fall in price multiplied to the value of the option at lower probable price would give you the weighted average of the option value by end of the year. Determine the present value of the same and you will get the value of the option. That is the process of applying risk neutral model. So risk neutral model will be simply resulting into same value of option which you have obtained in portfolio replication model. In fact, all the three traditional models, which three traditional models? One that you have learned some time back, portfolio replication model, one that you are learning now, that is risk neutral model, and one that you will be learning after this, that is binomial model. All the three models will have exactly same outcome, that will be same value of the call option. So let me help you with presenting the solution further. In this case, you just write one line that let the probability of rise in price be x, therefore the probability of fall in price will be 1 minus x. Substitute all the values in the equation as I have explained. I don't have to explain you how to solve the equations, you are great at that already. When you solve this equation, you get x equals to 0.2 divided by 0.3 or 2 by 3. So we conclude one thing, that the probability of rise in price will be 2 by 3 and the probability of fall in price will be 1 by 3. So I am just assuming that final CA or final CMA students should not be focusing on me explaining these equations, right? Let us move ahead and continue solving the question further by following an alternative approach, that is the other equation that we have learnt in portfolio replication model, where we don't take the rate of return but instead we take the value. So maturity value of risk-free investment will be equal to the weighted average of lower and higher probable price, and the weights will be same, probability of rise in price and probability of fall in price. So here the maturity value of risk-free investment would be, if you invest rupees 400 today in the money market, your 400 will become 440 after 1 year, because in the money market the risk-free interest rate is 10% per annum given in the question. So 400 will become 440. Instead, if you invest in stock market, it can either become 360 or become 480. So we have considered X as the probability of rise in price. So you don't have to write that assumption again and again. You have already written that X is the probability of rise in price. So 1 minus X will be the probability of fall in price. When you solve this equation this way, what you get at the end, in fact this version of equation will be much easier to understand compared to earlier version of equation, but you are free to solve the question either way. Here also you will get the value of X as 2 by 3, that is the probability of rise in price will be 2 by 3, so the probability of fall in price will be 1 by 3. The calculation of these probabilities, the question is what is to be done with this probability calculation. So we have already discussed some time back, value of option at year end, at lower probable price it will be 0 because it will lapse, at higher probable price it will be exercised, and MP minus EP, that is prevailing market price minus the exercise price, would give you 480 minus 440, that will be 40. Probable option value at year end will be 0 into 1 by 3 plus 40 into 2 by 3, that gives you 26.67. Present value of option will be 26.67 divided by 1.10, and the present value of the option what you get is exactly rupees 24.24. This is the value that you even got in the same scenario by using portfolio replication model. Let us move ahead and now take up the next concept, that is concept number 13, binomial model. And I want you to write up the formula for binomial model. I'll explain you this whole thing. Let me explain you. The whole root of binomial model is ditto copy of risk neutral model. So binomial model and risk neutral model, their roots of logic are one and the same, but binomial model is basically more of a mathematical approach. When I show you the derivation of this formula, I will be tracing the whole logic of nothing other than risk neutral model and explain you the whole derivation of this formula. So you don't have to take pains to by heart this ever. You just logically understand risk neutral model. As a follow up mathematical process, you will understand the derivation of this formula. But again, the derivation of this formula I have included in lecture 8A for your reference. As of now, I will directly help you in terms of how to identify and how to apply this formula. So for this purpose, we will have to take up a question, that will be question number 20. Let us read this question. This question again pushes you back to question number 17, and the question says use the data given in question 17 and determine the value of call option using binomial model. So I will display once again question number 17 for your reference. Same question which we solved some time back. The only difference is, in place of portfolio replication model, you will be applying the binomial model. Now friends, what I'll do is I'll show you the formula, I'll show you how to define all the variables, substitute the value of each of these variables in the formula and get the same answer which you got earlier in question number 17 as well as in question number 18, because the basic data is same, only the approaches and the models are different. But as I told you, explanation of that logic will come little later, that will be in lecture 8A. So the formula has been written. We will have to define all the variables. See, in examination, if you are following this binomial model and if you do not define these variables, you will not be rated properly. So you may lose marks. Take care of that. Just write up everything. As I told you, in lecture 8A, I have given elaborate explanation of this whole thing. As of now, we have just to understand this two value u and d. U and d are two such variables. if I am investing in stock, the money that I have invested is S0, and at end of the year, if the price goes up, the value of the stock becomes HPP. In other words, if I invest 400, it will become 480 after 1 year. So 1 rupee of today is becoming 1.2 after 1 year. If I talk about D, S0 of today will become LPP, that is 400 of today will become 360. So 1 rupee of today will become 0.9 after 1 year. So what could be the future value of 1 rupee if you are investing in stock market? If the price goes up, 1 rupee of today will become 1.2. If the price goes down, 1 rupee of today will become 0.9. But if you invest in money market, 1 rupee of today with risk free interest rate will become 1.1 after 1 year. So logically, we are using these three variables extensively, U, D and I. This capital I indicates 1 plus small I, that is 1 plus risk free interest rate. So let us move ahead and apply these variables in the formula. You don't have to write the formula again and again. I have written it just for your reference. You just write the substituted values in the formula and you would identify that here only you can identify that this is nothing but application of the same logic which you have learnt in risk neutral model. Why? Let me explain a little bit. 40 was the value of call option by end of the year if the price goes up, correct? And 0.2 by 0.3, which represents 2 by 3, is the probability of rise in price. That we have actually multiplied to 40, and probability of fall in price was multiplied to 0. But anything multiplied to 0, this is basically the probability of fall in price. That multiplied to 0 became 0, but logic was same. Probability of rise in price multiplied to the value of option when the price goes up, plus probability of fall in price multiplied to the value of option when the price goes down. But this will be the probable value of option by end of the year. If you want to find the present value, simply apply the discounting rate of 10% and find the present value, and you will get the value of C. That logic, when applied, 26.67 divided by 1.10 would give you eventually 24.24. So we can conclude that value of call option equals to rupees 24.24. I told you earlier as well, you will get the same result even by applying binomial model.